How are you, folks? Enzo DiCostanzo, clinical professor, economics and finance at St. Peter's in Jersey City. And today we're going to be working on, well, we have assignment 3 posted. What is today? Today's the 24th of September. So September's fluttering away from us. We have September 24th, which is Saturday. So we have assignment number 3 posted. And actually, let me just show you guys that. Yeah, assignment number 3 has been posted to Blackboard. And again, all 3 assignments are due on the 7th of October. You basically have 6 weeks to read 3 articles and answer a bunch of questions and make a graph. And, when I worked at Value Line, we basically did this 5 days a week. So, there's the rate of that. So just keep that in mind. You should be able to comprehend a Wall Street Journal article. You should be able to comprehend some economic rationale. You should be able to comprehend how to do some tax computations and things of that nature. Those are all things you guys should be able to do. So, 1 to 3 pages. Now, here's the thing. I went through the steps, how to make a cover page and PDF it. I did that previously, and we'll see towards the end of this, because this is not really, because we're not finishing the assignment today. So we're probably going to maybe do those steps in the next video, like tomorrow morning's video. I'll make one on Sunday for the Standard & Poor's graph. But today I was going to concentrate on the federal funds rate, and I was going to concentrate on interest rates versus the U.S. market and the impact of that, because that's all very hot, news right now. Okay, so it says who in the United States is responsible for setting the target interest rate, which banks lend, borrow and lend money to one another. What is this rate called? Define the discount rate, which is not the rate that we're referencing here. Impact on spending and investing. Why is the federal funds rate significant? Okay. Write a few lines on the effect of the interest rate on inflation and recessions. How do interest rates affect the stock market? How do interest rates affect the bond market? And then we're going to go to the St. Louis Federal Reserve data page. And today, this video will graph the federal funds rate. I'll show you where that data comes from. But also, just keep in mind, we have you guys have the student page or the student spreadsheet page. Actually, that's on Blackboard. And I should have had it posted already. So 1 second. Yeah, so when you guys go to regulation, if you scroll all the way to the bottom, see where it says spreadsheet models? Yeah, actually, wait, this is student regulation model. Yeah, that's what that is. So you have the Excel sort of set up for you already. Or not set up, but you have sort of something that you can look at if you need it. But like I said, my big wish is that you guys do all this stuff yourselves. As here's student regulation. So yeah, see, so I made a tab number 3, and the data is at the bottom here. Okay, so you could just work right off of this. Okay, so for the federal funds rate, all you need to do is graph this. This is your y-axis. See what it says federal funds rate? That's your y-axis right there. Okay. This is your y-axis, and the date. It's a time series, and here's your x-axis. Okay, that's all you really need to do. Okay, and you're gonna make a graph of that. Okay, and but what I'll do is I'll show you how this all unfolds and how this all happens. Okay, we're gonna go through that. Okay, and the data is this goes back to 85. You guys are a little young for that. 85. I remember that January the Challenger exploded. The space, one of the first space shuttles in the mid 80s. I remember walking out of high school, and I was, for whatever reason, I was only walking out the front door. I forget what was going on, why I was by myself. But yeah, so that January, I remember that January, or 86. Is it 85 or 86? I think it might have been 86. Yeah, so but I remember that event happening. So that was around that time. Anyway, so if I could have gotten more data points, I would have but yeah, this was so yeah, January 86. So you guys probably I remember this, the rockets going in two different directions. This was the classic photo of this stuff. Because there were there's four sets of engines on this spacecraft. The shuttle had its own. These are the two booster rockets, and there was the main thruster rocket. The booster rockets just to lighten the weight of the fuel, because basically these were missiles that you strapped an aircraft to. Is really what this was. So that this happened, Richard Feynman was one of the physicists who talked about the O-rings, and there was a leak, and there was some very flammable jet fuel or rocket fuel, and hot, cold, a spark. It all sort of came, all that stuff, something that's flammable or combustible, hot and cold, and leaking fluid. None of that is good. And anybody knows anything about mechanics and physics, none of that stuff is, or chemistry, none of that stuff is really good news. So that all happened. So yeah, this is what the space shuttles. You guys probably don't even recall what these. This was a big deal because at one time the rockets, the astronauts were on the nose cone. At one time they were just sort of up here, and none of this other. There was no aircraft attached to it or anything like that. All of this stuff falls off, and this thing comes back as a glider. The space shuttle comes back as a glider. Remember you guys don't remember this, but the Buck Rogers in the late 70s and the early 80s. This was at the this is his spacecraft that he sort of got frozen in for 500 years. That was the story of the Buck Rogers sign. It didn't last very long on television, but I remember that was on. But he was in a shuttle. And 1987, funny enough, was the year he was supposed to have went into deep space and whatever it was. So anyhow. But yeah, so the 86, it was 86, not 85. Sorry about that. So yeah, so anyhow, this was the number 8 is the federal funds rate, and number 9 is the Standard & Poor's. I want to do a little bit of a comparison. How does the stock market react, or how does the Standard & Poor's index react to what the interest rates are? And we're going to get to that. And also, I sent this to my guys down in Florida this morning. And I'll quickly try to find it for you guys. How this, and this will be another video. But for the year, for the week, this is for the week. For the week, we're down 4, 5, 6%, depending on the index that you're looking at. And for the year, we're down. The least down is 18.6, which is nearly 20%, and the Nasdaq is down 30%. Okay, I think the depression that we were down 50%. All those decades ago, that century ago, whatever. Yeah, it's almost a century ago at this point. So just keep in mind, we're nearing, that territory. What was the 1929 stock? And watch the number come up just by its. Yeah. Okay. This was down 24%. And that was considered a depression, right? That was considered the depression. So do a comparison to that, right? Do a comparison to that. Yeah. Okay, so that was considered, that 29% drop was, so, and we're there. So we're not calling it the D word, but if there's another word, let me know. So, but people are working. That's the difference. The employment is still relatively strong. It's all going to catch up. That's all going to catch up with each other. So anyhow, yeah. So you have this Excel sheet here. It's down at the bottom here somewhere. Yeah, right here. Okay, so you can use this, and it'll just pop up. And like I said, folks, you can't work on the attachment. Okay, you have to work. You have to download it to your PC. Like you have to download it to your hard drive, and you have to work from there. All right, it's that the program's got to be. It can't. The attachment viewing is just for viewing. You can't work in Excel, and that I hope everybody realizes that. So, okay. So anyway, that's coming in terms of the assignment. Okay, this is assignment number 3. So you have to make this graph, the Standard & Poor's graph. You have to make the federal funds rate graph, answer these questions, and you have a nice you have 10 pages of reading here. Obviously, this is not all highlighted, but the version I'll talk about is going to be highlighted. And we have a little bit about the expansions and how long someone did the math on this, how long the expansions. You could do it yourself. You could just look at the S&P and even going back to whatever we have, 86 or whatever it may be. So where would we be with that? We would be in the middle of this expansion, actually more towards the beginning, but this 82 to 90 expansion. So you would get maybe 45 months or so of the 19, which is basically most of the 80s, most of Reagan's years, most of Bush number 1's years, kind of a thing. And then you had a very small blip from 90 to 91. You had that little bit of a recession, and then you had another decade where we rode around like gangbusters. That expansion, and then the next expansion started again. They had a brief you had the dot-com burst, but you had another brief recession, and then November 01 to 07 again, almost another decade. So these are decade-long runs, even from the 40s and the 50s. You had in the 50s, you had two pretty good expansions, and even 45 to 48, you had a pretty good expansion. And you can see the recession. You had a trough from 48 to 49, didn't last that long, right? And all that. So I think we looked at the employment graph and anything that the Federal Reserve puts those graphs. I've yet to determine how to make those vertical shaded areas, but give me some time and we'll get to that. So okay, I don't know why there's such a big divot here on this. This should be like that. Folks, notice what I just said. See, when you're in Word, if you have PDF Writer installed on your PC, all you have to do is just hit the save file as the PDF button, like I just did. And you can see here, it says save as PDF, and it creates a nice a portable document file for you. Want to replace it? Yes. Okay, and that's it. Okay, but you have these three assignments that are due. You have plenty of time to do them. You have 1 week, 2 good weeks, 2 week. Actually, it's this weekend and next week. You have 2 weekends to work on all this stuff. But folks, that's it. October 7th, the vault door, boom, right, slam shut, and that's that. Okay, so we have to, there's got to be. It can't just be let's throw this together. That's not what I'm teaching. You got to work piece by piece and step by step, and you're making it so unnecessarily difficult on yourselves when you're, so unnecessarily difficult on yourselves when you're trying to my computer hung up a little bit, trying to sort of pile it all in at once there. Folks, I apologize. I should have restarted this computer before we hit all this, but okay. See, so again, with a little bit of drama there with the Word documents. Okay, I don't know what happened there, but and again, even presenting with the because if I want to make some change, I want to have the Word document sort of sitting there. No. Okay, so everything reopened for us, thank God. So which is a nice feature of Word. Here we go. Okay, this is what I wanted to discuss today, and this is some other stuff here. This is what? What is this? Yeah, this is the CD. This is an acquisition we're working on. Let's not worry about that right now. Yeah. So okay. Yeah. So there's anyway. Anyhow. So yeah. So here. So today we're gonna hit the graph for the federal funds rate, and I want to discuss interest rates and how they affect U.S. markets. So changes in the interest rates have both positive and negative effects. On markets, central banks often change their target interest rate in response to economic activity. So again, what comes first? Does the interest rate influence the economy, or does the economy cause the Federal Open Market Committee to change interest rates? And actually, just as we're sitting here, what I wanted to work on, FOMC transcripts and everything, monetary policy, right there. I just wanted to just very quickly look at the latest press release, if you guys don't mind us doing that. Here we go. So yeah, I was explaining this at my other job, so we'll explain it here too. So look, This talks about GDP. This talks about the unemployment rate. PCE is personal consumption expenditures, and then the core PCE is subtracting out energy and food prices. And here's the thing: as the core uh, expenditure inflation, core personal consumption and expenditure inflation appreciates or gets bigger, that's a concern, because that's without, you can't say, oh, it's just energy and food prices, durables, non-durable services. That's everything, all that whole consumer basket of goods. And actually, the Federal Reserve has its own version of the inflation index. Let's see, CPI. There it is. And you could have a whole different. Now, this is the Labor Department's version of this. It's not necessarily the Commerce Department's version of this, and the Treasury has. I'm sure they've got their measure also. Yeah, this is a nice. I like the three-dimensional ones. Let's hopefully we can read this. Yeah, so again, the CPI. This is an index. An index is a number. As it gets bigger, it's appreciating. It gets smaller, it's getting less. So I don't say big or good, but certainly for this valuations in the stock market, as the Standard & Poor's index increases, that's a good thing. Okay, but as the consumer price index increases, that's inflation. That's a bad thing. So I don't want to say big or good, small or bad, but it depends on what the index represents. But as you look at this, that numerical scale: food and beverages, housing, education, recreation, medical care, transportation, apparel. That's how the Labor Department determines an inflation index, and then they take a percentage change either month over month and annualize the number, or a year over year, directly year over year percentage change. And that's the inflation that you hear, the White House press secretary, my favorite person, the White House press secretary, talk about it. But the people actually do know what it means. We'll do a month over month change, and it could just be month over month, or you can annualize it. And by the way, the way you annualize a month over month change when you have 12 months a year, you take 1 plus that month. Let's say the month over month change is 0.1% or 0.2% or something like that. You take 0.2% plus 1, raised to the 12th power, subtract 1, and then now you've annualized the number. So in other words, it's as if every month in the year behaved as that month over month change behaved. Or you could just take this September or this August to last August. That's a year over year change. Okay. So that's core inflation. Now, but these indices, and again, these are the rates that we've computed. Again, same manner. You could do a year-over-year change, or do a quarterly change, or a monthly change, or what have you. And then it's called annualizing. We're not going to spend a lot of time on that. Last year we did, but this particular year I'm not going to. I'm a little more with the news, a little more with the tax work. This particular year. But the predictions of an army of economists at the Federal Reserve, their predictions in June were in the median of, let's say, 20 economists. I don't know if it's 20, but it's probably around that kind of a number, or 20 groups at least. The June projections for 2022 were 5.2, but as of the September meeting, they're 5.4. So we think inflation is going to be higher relative to June. The PCE, the overall inflation, and the core inflation from 4.3 to 4.5. So in other words, our June predictions were 4.3% for 2022, and that's 4.5% for 2022. And then unfortunately, across the board, all of the September projections were higher than the June projections. So bad for all the inflation measures. The federal funds rate, again, across the board, we think it's going to be higher this year. We think it's going to be higher next year than we thought a couple months ago. Same thing with the unemployment rate. Unfortunately, we're looking at a little bit of a higher unemployment. Again, not bad, 4% unemployment, but and again, that's the now again. Here's what the banking guys and all these folks say. Okay, well, the government's spending all this money, we're employing people, but you're going to have less demand, and then how do you keep paying people either through government checks or in the private sector, which is certainly the better way to employ anybody. How do you keep that cash flow going? That's what the concern is about. Where, okay, the government wrote some checks and we still have a lot of taxpayers, and we're collecting trillions of dollars in taxes from the working public and corporations. Actually, it's from people. The majority of federal taxes are collected from a person. The corporate federal tax number is in the hundreds of billions, while the personal consumption one is easily over 3 trillion, if not more. So it's people paying all this. It's not the companies. The companies have a lot of arrangements with the government. Obviously, they're hiring people. There was the Paycheck Protection Program. So there's all sorts of deals that aren't so apparent. And all of this hocus pocus as to who's supporting what and why. Any business, no matter what the noisy politicians may say somewhere, any business wants to have a good relationship, unfortunately, no matter who the politician is and what they say, but they're going to want to have some kind of an arrangement where the heavy hand of government regulation doesn't come down in the banking sector, the energy sector. And you can see the impact on energy in this country, where we have people, maddeningly, trying to curtail domestic, energy production to the detriment of the population of this nation. That's just the reality. That's not my opinion. That's what's happening. So again, how do you keep writing checks if there's going to be less, again, if there's less people working, the federal tax cash flow will diminish, and collecting those taxes. And okay, fine, there was some big story about we're going to hire tens of thousands of new agents. We're going to have tens of thousands of IRS workers retiring. So again, there's a lot of noise about something. It's really unfortunately, it's to instill fear on people, which is really kind of terrible. The June projections, and this is sort of going in the other direction now. The June projections for economic activity, GDP, economic activity was 1.7, 1.9, and those are certainly for 2022. It's diminished dramatically from 1.7% to barely no change from a year ago, or 0.2% of a change. 2023, it's going to be lower. 2024, so we're barely. This is Obama era. Gross domestic product change. So, hey, you have Obama's policies, yet you're going to have Obama's, economic results, and that's in the longer run. Okay, but that's hope. This is just a wish. All of this stuff. Of course, they're going to say, oh, well, the federal funds is going to do 2.5%. Unemployment's going to be, 3 or 4% or something. But so these are some of the numbers. This was the recent meeting that we were in class. These are some of the recent meetings. Now, central tendency ranges. These are all statistical measures. The range is, the lowest projection, the highest projection, kind of a thing. So people are a little more statistically minded. You guys can look at this stuff. Okay. Central tendency is the same thing or similar. Excludes the 3 highest, 3 lowest projections in each year. So they give you some for the people who aren't so statistically, knowledgeable. They give a little of what the median is. Half of the projections are on one side, half are on the other side. So you could have, looking at some of the ranges here, the long run projections for GDP change go from 2.2% to 1.6%. That's a lot. That's a 0.5%. When you're talking about 25, 33 to 25% of your endpoints difference. Okay, so that's not a small amount when you look at percentages. Okay, and let's see what the statement was. That's projection materials. And here's the statement, and hopefully it said something here. I'm looking for the press release, and there's more tables here that go into a lot of depth in terms of the detail of all of this. And here's the statement, which is right here, the implementation note. This is short. It says recent indicators point to modest growth in spending and production. Okay, so that's supply and demand. Okay, job gains have been robust in recent months. The unemployment rate has remained low, but inflation remains elevated, reflecting supply and demand imbalances related to the pandemic. See, the thing with the financial markets can kind of react because you can buy and sell in a day or 3 days or something like that. But firing people, building factories, buying equipment, buying mining equipment or not buying mining equipment or whatever it might be, that takes a little more time. So the ripple effect and the trickle down throughout the whole economy, we really haven't seen that yet. So inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. And we love to go back, the pandemic, sure, okay, what the pandemic made the government, the federal policy, federal decision makers create federal policy, what that policy is going to be, to spend more, regardless of production. And now I'm hearing from the president of Ukraine and the UN folks. A lot of things happen in September. The UN has its general meeting, and there's higher fertilizer prices. There's higher prices to farm in Africa, higher prices to farm in probably in Ukraine. Anywhere, that's certainly in America, there's higher farming prices. When you can't buy as much fertilizer and you can't buy as much of the inputs into farming production, you're going to have less of an output. So are we headed for a food crisis? I hope not. I really hope not. But that's the UN. They're concerned about that. Again, Russia's war against Ukraine is causing tremendous human and economic hardship. The war-related events are creating additional upward pressure on inflation and weighing on basically what I just said, global economic activity. The committee is highly attentive to inflation risks. And where are we now? Okay, so looking at this, so what is the monetary policy attempt? What is it the Federal Reserve endeavor to do? The people who really study and control the money supply, they seek to achieve maximum employment. And inflation in the rate of 2% over the longer run, the annual 2% change. So the committee decided to raise the target range for federal funds to 3.75%, which we're going to talk about the federal funds rate in the lecture today, and anticipates that ongoing increases in the target range will be appropriate. Again, the people who make these decisions are telling you they're going to keep raising interest rates. If they're telling you that's why the market fell off a cliff at 4 or 5% this week. And it was another one of these, right? Whatever, not the August one, but probably the July note pretty much said the same thing. In addition, the committee will continue reducing its holding of treasury securities against shrinking the money supply and agency debt. And in other words, commercial banks have less money to lend its customers, agency mortgage-backed securities. And those are all just very fancy financial instrument terms for, we put money on the balance sheet of commercial banks, and we have a receipt for it. These are all the financial instrument receipts, so that they could call back that money anytime, which is what they're doing. So that, in other words, and when you're the regulator, you have governmental power. You can force the commercial banks to say, okay, it's time for you guys to buy back the securities, kind of a situation. Or really, they're going to, what's really happened? They're going to evaporate off the books. That's really the money. We're already in cryptocurrency world. Like, the money is already electronic. Of course, I still use cash. I go to McDonald's. I still use cash. Now, I went to McDonald's a couple weeks ago, and the woman pointed to there's like a little, a little cash, a little ordering station where you could go, hamburger, French fries, whatever it might be, and they didn't want to listen to me. I think they're trying to train the customers to just either order through the phones or order through those little kiosks or something. It's like the train tickets in New York. I haven't bought a subway card when I used to be in Manhattan all the time. My last years in Manhattan, I didn't buy subway cards from a person. Right when I was a kid, I bought a token. You had a physical token, like a coin, it's like a quarter, and you dropped it in. And you had these tokens you had to buy, like a roll of tokens is like a roll of money. And now I bought the subway card from, and that works on the PATH train system. I bought the subway card from the little kiosk person, or little kiosk terminal. And then same thing with the transit tickets. I would just buy 10 of them. The New Jersey Transit. Again, not buying it from, even though there were people there at the windows and all this other stuff, but you didn't have. It wasn't like when I was a kid where you lined up to buy from a person. I don't think those self-service stations even existed when I was your age, or in the teenager, or in my 20s, or anything like that. But folks, the federal funds rate now is higher. Okay, and we're going to look at actually just looking at the numbers. Where are the numbers here? We're up to 3-something%, right? What has it been? Well, for a while, right? It was pretty low. Here, let's hook on to, even to March. Forget it. Even to April 2020, it was 1/3%, and going all the way back 1/3% to March 2020. Obviously, it had to fall off a cliff because of COVID. But even before that, it was very low. In the 2016s, the 2015s, the 2013s, it was zero from 08, right? From March 08. Or probably October 08, right? It was very low. That's falling off a cliff when you go from that's a percent change, a 0.5% change, 1/4% change, and then who knows? They just held it steady for quite a while. So from whatever that was, '08, and the NYU guy, the Black Swan guy, forget his name, Talib something, uh, Rubini, or to whatever his name, Rubini or something like that. The guy wrote Black Swan was a very unusual event situation. We were at near zero interest rates from October '08 all the way. It was 12 years or something. It was quite a while, all the way to 17, right when Trump was in. That's a decade. That's almost a decade, right? That's quite a while, still quite a, and even this 1%, 2% still, and then obviously had to fall off a cliff again. And now we're having cardiac arrest. That's cardiac arrest going from, we were at zero in February practically, and now we're at about 2% or 2.33%. That's a lot. That's a big change. Okay, and again, these guys are focusing, they're target now. They get to set it, and we're going to talk about it in the lecture today, but a lot of business and corporate loans are based. All of them are based on it's a supply chain. The banks get a commodity, they get cash, they get a commodity to lend to the public to grease the wheels of the economy. And if they're getting charged more, for loans and different things, I'm saying not certainly the Federal Reserve discourages lending or borrowing by commercial banks directly from the Federal Reserve. But if you're borrowing from one another, the federal funds rate is really commercial bank to commercial bank loaning of reserves. If you're paying more for those loans, you're going to pass it on to the consumer, which is the same thing with the tax situation. The consumer pays the majority of the tax. Corporations pay a few $100 billion, and that's if you can believe that, and that's about it. But the federal government spends like $6 trillion. Okay, so it's it spends a lot. So anyhow, we'll continue to reduce holding. We have talked about that. It's a committee strongly committed to returning inflation 2% objective. And there's all this other stuff. It says, in assessing the appropriate stance of monetary policy, the committee will continue to monitor implications of incoming information, the economic outlook. The committee is prepared to adjust the stance of monetary policy as appropriate if risk emerges that could impede the attainment of the committee's goals. The assessments will take into account a wide range of information, including readings on public health, labor, market conditions, inflation pressures, inflation expectations, financial and international developments. Okay, so what's what are the inputs into the monetary policy decisions that are made by the Federal Reserve, and there they are. Okay, but this was a nice little read. Like I said, this, instead of me giving this to you, just go to the Federal Reserve website. Okay, and just pick it all. Board of Governors, Federal Reserve, it's right there. Okay, so you just grab that. Okay. All right. Finally, let's get to the lecture, right? But we've been right. So, and looking at this, it says the Federal Reserve Board is responsible for setting the target interest rate at which banks borrow and lend money. We just said that to one another, known as the federal funds rate. We looked at the policy and we looked at the history just now, and also I'll explain that list of numbers, where that all comes from. And this has a ripple effect across the whole entire economy. Well, it usually takes at least 12 months for a change in the interest rates to have widespread economic impact. The stock market's response to a change is often a little more immediate. I said that already. In addition to the federal funds rate, the Federal Reserve sets the discount rate, which is commercial banks borrowing directly from the central bank. It says, or the interest rate the Fed charges banks, member banks that borrow directly from it. The rate tends to be higher because than the federal funds rate, to encourage banks to borrow from one another at the lower federal funds rate. Okay, which is what we're trying to do here. See, I like to have it so I can edit it as I sort of go along here. Understanding the relationship between interest rates and the stock market can help investors understand how changes may impact their investments. Now, anything in the stock market is speculation. An investment is buying mining equipment or buying property. Those are investments. Buying real estate or something like that. That's an investment, or building a hospital, or those are all investments. Buying securities, buying an instrument it's all speculation. 100% in speculation. There's no investing that's going on in any kind of stock market. That's for sure. Investors understand how changes impact their investments, or their speculation. They can also be better prepared to make better financial decisions. Below, we'll examine how interest rates can affect the economy, the stock market, the bond market, inflation, and recessions. Okay, so that's everything, right? That's pretty much everything. When the central bank, central banks like the Federal Reserve, charge or change interest rates, it has a ripple effect throughout the broader economy, affecting stock and bond markets in different ways. Lowering the federal funds rate makes borrowing cheaper. This encourages consumer and business spending and investment, and can boost asset prices. Because you have a lot of activity, so people can borrow money to buy securities, which can artificially boost the, well, I don't know if it's artificially, but it'll boost the price if a lot of people are chasing these instruments. The prices are being bid up, right? Lowering federal funds rate can lead to problems such as inflation, liquidity traps. Obviously inflation, obviously the prices of everything, getting much more expensive. A liquidity trap means you've got to make payments you don't have the cash to do it, or you're stuck you're stuck in like an instrument that you can't convert to cash quickly. Those are liquidity traps, which undermines the effectiveness of the low rates. And actually, I want to get a better uh, Cyprus hit the liquidity speed bump. Yeah, so it's from the Keynesian guys. This stuff. It says it's a contradictory economic situation where interest rates are very low and saving rates are high. Yeah. So again, rendering monetary policy. So people are, money's in the mattress, which is basically what I said. So first described by the economist Maynard Keynes, the liquidity trap, consumers choose to avoid bonds and keep the funds in cash savings because of prevailing belief that interest rates could soon rise, which will push bond prices down. Would that be right? Well, yeah, yeah. Again, it's the bidding on the debt instruments. So if interest rates are getting higher, now he's saying that would push bond prices down. Well, yeah, if there's a new issue and you're getting a better rate, so people are coming out of the current bond instruments and going into other debt instruments. Okay, so you have a force of policy that sets a higher interest rate because then companies have to borrow it at higher rates, kind of a situation, and then you have the force of the capital bidding for those debt instruments. Okay, and what's going to, which force is going to be greater? Is it the force of the government, the hand of government, or is it the force of the free market chasing the instrument, seeking a return, kind of a situation? So it says many consumers do not want to hold an asset with a price that's expected to decline. At the same time, central bank efforts to spur hampered as they are unable to lower interest rates further to incentivize investors and consumers. Okay, so yeah, but basically, liquidity traps are, you need to have liquidity, you don't have it. Okay, that's really what a liquidity trap is. But okay, their definition is slightly different than what I just said. That's fine. Higher interest rates tend to negatively affect earnings and stock prices. Again, if your debt number, if you're paying more to the bank than to the shareholder, instead of dividends or cash buybacks or stock buybacks or something like that, it's going to the bank for debt payments. You're reducing the earnings available to the common stock, to the common shareholder. That's what's going on. And it says, with the exception of the financial sector, again. So people who write these notes, I don't know if I necessarily agree with that, but it's good though. It's when something comes along where say, hey, I might not go. He said, again, I might not go with that statement. Higher interest rates means banks are getting a bigger payment for their loans, but are they making less loans? So again, which controlling force is it? The idea of more customers, or is it the idea of or more or less customers, or the idea of a higher interest rate to get a bigger payment from each customer? Which one of those is going to be stronger? Okay, that's empirically, you have to figure that out. Which means the actual data that happens. Any impact on the stock market from a change in the interest rates is experienced fairly immediately. Meanwhile, for the rest of the economy, may take a year to see any widespread impact. Well, yeah, a real estate transaction, buying, mining equipment, that stuff does take some time to make those decisions where you could buy and sell shares and debt instruments and stock instruments pretty quickly. The interest rate that impacts the stock market the most is the federal funds rate. It's the rate that it's the interest rate that depository institutions, banks, savings loans, and credit charge each other for overnight loans. So, okay, why are banks borrowing from another? You've got to have a certain amount of capital on your books, a certain amount of capital on your balance sheet to satisfy regulatory ratios. So it's capital to risk. Basically, the Basel definition is capital to risk weighted assets, and there's a whole all sorts of classifications of the equity capital and what the risk weighted assets are and all these other kinds of things. There's all sorts of definitions to that. Where the discount rate is interest rate the Federal Reserve Bank charges when they make a collateralized loan, usually overnight to a depository institution. So again, the preference of the central bank is that the system borrows from itself, or just moves, sloshes the money around from one bank to another, instead of going back to mom and dad, pretty much. So the Federal Reserve influences the federal funds rate in order to control inflation. By increasing the federal funds rate, the Federal Reserve is effectively attempting to shrink the supply of money, which is what's going on right now. Now, the trap, the liquidity trap, or just sort of the policy trap, and making a bigger statement about it is and we basically were in a liquidity trap in a sense for a number of years where you couldn't reduce the federal funds rate any lower, and again, you had Obama era, very bland, low level economic activity, growth and changes, where the Trump era, and forget about Trump this, Trump that, it's the ideas and the policies where, business was unleashed a bit. And it's a shame that, and folks, believe me, I'm not in a fantasy world about, why people feel or like or don't like, certain politicians or whatever it might be. But, I can certainly understand, the reservations people have about a really, a sharp edged, New York businessman, but also that's the guy that the country needed after a very blasé, Obama year, Obama era, two-term president, very, uninspiring growth. We needed a little fire, and I think we need it again. Okay, but again, he can. Trump's not, let's say he gets in, or similar guy gets in. There's no, if it's Trump, it's going to be, if he does get in, it'll just be another 4 years, and that's it. And it's almost like he's still president because he's talked about so much, right? It's not even funny, but DeSantis getting in, hopefully, I don't know if maybe DeSantis runs as vice president. I mean, to me, this is just my humble opinion, but the ideal would be, a Trump return, and then DeSantis as his vice president, DeSantis runs for 2 years, and we have a whole, decade of just sanity and really, and this is not to be horrific, but just trying to solve the social ills and the social issues that the Democrats are soapboxing about, and using their bully pulpit because our politicians, our Congress people say, hey, what about this, what about that? But you never, you see, society, I think society is better at solving problems than any kind of governmental agency to solve problems, because as an entrepreneur, even though, okay, fine, if Trump and his kids stopped working tomorrow, their lifestyle wouldn't change one bit. They could live the same way. Their kids could live the same way. Their grandkids can live the same way they're living right now. But there's just something in any entrepreneur, there's just some fire in there that makes you want to pursue. Same thing as a baseball player, a baseball pitcher. Verlander, how old is the Houston guy, that pitcher? How old is he, right? And all the years in Detroit, and when Detroit was actually good for a couple of years in the mid 2000s, and he's just going and going. He was out for 2 years with, the Tommy John surgery. What Clemens was another one. These guys are bulldogs, and they just go and go and go and pitching. They want to compete. They love to compete. Trump loves to compete. That's what, it's not about money or anything like political power. It's he wants to see the country healthy, and I think what he understands and the Republican Party understands is that you have to have a happier country, not just appeasing people, but you got to have a happier country than you have right now, because the long-term effect of sort of all this misery that we're seeing is not very good. Okay, it's not very good at all, and it's not going to be a good thing or helpful thing or useful thing, that we're long-term and long-term unhappy, and then long-term these massive separations between different parts of society. That's we need to figure out the answer to that. And I'll tell you, the collapse of the church was I think a big part of not collapse, but just the place in society, certainly in America. Latin America, it's a little bit different, but in America, I think the trust that we have in the church is not, maybe it's for a Catholic church, this, that, and the other thing. Just a lot of the religious organizations, the distrust that we have is bad. That's not, I didn't grow up like that. I grew up where the parish priest, you trusted the guy, the Jesuits, you trusted them, and when that faith gets shaken, and it's people doing things they shouldn't be doing, across the board, and that's something. And whatever the denomination is, Episcopal Church and different things, and the clerics in the Middle East, maybe they're taking advantage or whatever of the trust that people have in them. It's a slippery thing that happens. I think that happening is what got us here, and then now it's just secular. You don't have the spiritual part as much influencing anymore. When in Europe, it's still that way, which is important. So anyhow, the Federal Reserve influences the federal funds rate in order to control inflation by increasing federal funds rate, and the Federal Reserve is effectively attempting to shrink the supply of money. Okay, that we're doing that now. This in turn makes money more expensive. Conversely, when the Federal Reserve decreases the federal funds rate, it increases the money supply and encourages spending. It makes it cheaper to borrow. The central banks of other countries follow similar, European and what have you. The Central Bank of London, the Japanese central bank, we were in that mode post-COVID, and now we went back to sort of the first scenario here, right? Increasing, trying to cool off spending, trying to cool off economic activity, and here's sort of one of the main reasons why. It says the federal funds rate is significant because prime interest rates, the interest rate commercial banks charge their most creditworthy customers, is largely based on the federal funds rate. And I remember, really big financial instrument traders, really big real estate speculators and buyers, really big, very sophisticated financial people. They have a very, if you come in with 10 million to Wells Fargo, you're getting a deal. Okay, prime interest rate means it's low, and it's or somebody who's defaulted on 3 car loans, compared to people who can borrow from banks at very favorable rates, and the prime rate is that it's a low rate, or the lowest rate the bank can offer. But if the federal funds rate is high, it increases this whole list: mortgage loans, credit card annual percentage rates, other consumer loans, other business loan rates. Okay, so there's a whole list of anything that's a credit product gets impacted by the federal funds rate, and starting with the bank's best customers, right going down right to the car loans. So, and actually, if you look at as we're discussing here, in terms of the assignment, I'm going through the answers to the question. Obviously, number one, right? Everything that we spoke to now, sort of answers number one. Let's see, where's the spending thing? Here's spending and yield. Why is the federal funds rate significant? So yeah, like the first three, what is it? Why is the federal funds rate significant? What other areas does it impact? So yeah, we just answer number three is just right here, okay? Because it impacts the details of all these other loans. Now we're going to looking at spending and yield, right? It says, how does interest rates affect spending? Okay. And then we have, inflation and recession is next. So just all the next couple sections. So now we're up to 4, spending and yield. We're up to number 4. And here's what it says. It says, with every loan, there's some probability the borrower will not repay the money. So to compensate lenders for that risk, there must be a reward. Interest, obviously interest is the amount of money that lenders earn when they make a loan, and that the borrower pays. And the interest rate is the percentage of the loan amount that the lender charges to lend money. Okay. So the existence of interest allows borrowers to spend money immediately instead of waiting to save the money themselves. The lower interest rate, the more willing people are to borrow money to make bigger purchases, such as houses or cars or durable goods or things of that nature. When consumers pay less interest, this gives them more money to spend, which can create a ripple effect of increased spending throughout the economy. So let's look. What is impact yield from interest rates, spending and investing? Well, yeah, and actually, here's the yield stuff is right here, right? And it says, it just said it right here. It says, we see here. It says, what is the impact on spending and yield from interest rates? Well, there it is. It says, fine, okay, and also there's more of this here, and it says, okay, these are the definitions here. Spending immediately, it says when consumers pay less interest, it gives them more money to spend. Right there, right? Spending and investing, which is right there, which creates a ripple effect of spending throughout the economy. Business farmers benefit from low rates, encourage them to make large equipment purchases, tractors and whatever, earth moving equipment. This creates a situation where output and productivity increases. Conversely, higher interest rates, consumers don't spend don't have as much disposable income and can cut back spending. When there's higher interest rates are coupled with increased lending standards, banks make fewer loans. Okay, which is right there. So spending and investing from interest rates. Okay, which is that. And certainly in terms of when we say yield, obviously, if you're talking about a debt instrument and there's a higher, federal funds rate, those instruments are going to have a bigger, annual yield, which can make they're easier investments, and they're a little more lucrative to be a part of. Oh, and here's some other yield stuff. It says the effects. Not only consumers, but businesses and farmers who cut back on spending on new equipment and slowing productivity or reducing number of employees. The tighter lending standards also mean that consumers will cut back spending. This will affect many businesses' bottom lines. So also, spending, fine. Okay, we're looking at this. It says when consumers pay less interest, they have more money to spend. So certainly a lower interest rate gives, there's more consumer spending, not spending on debt, but more consumer spending on cars and houses and vacations and just all general economic activity. You have a lot more commerce happening when the money isn't just going back to the bank to pay off debt or make a debt payment, kind of a situation. That's when you have a low interest rate. When you have a high interest rate, you don't have as much disposable income and you're cutting back on spending. Right there. Okay, so what is the impact on spending from interest rates? What is it? What is the impact on yield? Here's the yield part of that question. It says, okay, fine. you're a speculator. You can buy Dow Jones stocks, dividend yield. There's a dividend yield to the stock. It's returning cash, returning part of the earnings back to the common shareholders. Interest rates on certificates of deposit, where there's a little more of a structure to the capital. You have to leave the capital in the bank a couple of years, 3 months, 6 months, 9 months, a little bit more. There's yields on treasuries. So again, as federal funds rates increases, the treasury yield will be higher, the certificate of deposit yield will be higher, and again, capital might come out of the speculative market, where you're not gonna bank on, okay, well, even though it's a Bank of America, even though if it's a JP Morgan, even though if it's a Walmart or a Verizon or something, if I'm guaranteed 4 or 5% with treasuries, or maybe 6% with certificates of deposit or more, why am I gonna gamble in the casino known as the stock market, when I got the two of the three choices here, right? You have treasury bonds, bank certificates of deposits, or dividends from blue chip stocks, or dividends from Dow Jones companies. The first one is the biggest risk one, because you don't know, there's no guarantee what earnings are going to be. We're projecting this and projecting that and making estimates, but there's no guarantee what the dividends are going to be here. Okay. So, money's going to come out of this, money's going to come out of the stock market, and it's going to pile into these fixed income products. And as the price gets bid up, you're shrinking the effective yield. These things are issued with a coupon, but the price you pay for the instrument is market determined. The coupon payment is not. Well, the coupon payment is based on the federal funds rate. Okay, so among these three choices of yield, it says investors will often choose the option that provides the highest rate of return, the highest yield. So the current federal funds rate determines how investors will invest the money, as the returns on CDs and T-bonds affect this rate. So yeah, so just again breaking this down. So look, if it's a JP Morgan or Bank of America or some other Dow Jones company or whatever it might be, Walmart is probably in there. Apple's probably in there. And here, I had the list of the Dow Jones companies. Let's just quickly take a look at them. Oh, Depot is in there. Yeah, here they are. Yeah, Goldman, Home Depot, McDonald's, Microsoft. I forget how Coca-Cola. There's 30 of them, the Dow 30. Intel, Walgreens, Verizon, Cisco, Dow Jones, the news corporation itself, Coca-Cola, Nike, Walt Disney, Morgan, 3M, IBM, Walmart, Procter and Gamble. And you can see it's the spectrum of. I liked having the list where they show what the companies, the Travelers, which is insurance, they show what the companies are, like the industry that they're in. The Wikipedia is going to have that. Yeah, there it is. You can see conglomerates, financial services, whatever. Retailing, financial services again, insurance, Travelers, and this is almost Warren Buffett's portfolio, right? Home improvement, Home Depot, Lowe's is in here, McDonald's, food industry, Johnson and Johnson. Okay, so you have some idea, and this is date added. So some of these were recent. Amgen was recent. American Express was in the 80s. 3M was in the 70s. But there's one. I think Ford, is Ford still here? Yeah, Ford would have been one that would have been around for a while. But here it is, Procter and Gamble, 1932. I knew there was one that went back forever, right? 1932. Think about that. Fast moving consumer goods. But then after the 32 one, there's nothing from the 40s. There's nothing from the 50s. That one, believe me, that one is there for sort of historic purpose. Coca-Cola's been there. Well, Coca-Cola was and it was in and out. It was in and out. It was 32 to 35 they were in, and then they were back again in 87, kind of a situation. Cisco was recent. IBM, I think, was the 70s, right? IBM's probably the 70s or something. They were there in the 30s, but we were 79. Okay. Intel, semiconductor industry, Disney broadcasting. And you can see the weights, the percentages of these. And like I said, I taught that in a statistics course a while ago, how we got all that together. So the Dow divisor, how they determine that index. Initially, it started with you took the prices of 10 companies, you added it and divided by 10 companies. That's how it started, but it's a little more complicated now. So, but anyway, there you go. But so the federal funds rate impacts speculators, financial instrument purchasers, and things of that nature. Okay, so that's that. So that's number 4. Okay, your answer to number 5 is interest rates and inflation on recession. Oh, surprise, surprise. And again, so just look through these this one little page here. It's about one. It's less than a page, and like I'm discussing here, you might get a little narrative. It says whenever interest rates are rising or falling, you hear about the federal funds rate. Fine. When the interest rates are rising or falling, you commonly hear. Okay, we already saw that. I don't know why there's 2 of them there. There should just be one. Um, it says this rate is the rate that banks use to lend money to one another. It can change daily because this is the rates affect movement affects all the other loan rates. It's used as an indicator. Yeah, and actually, as you look here, we all know that the federal funds rate only gets changed, potentially 8 times a year. If you look at the data that you have here, you might be saying, just wait a second, professor. It's this is May, June. Why is it moving around so much? Well, certainly number one, the policy change right as time goes on, but also this rate is really any effective rate is what's been loaned and what are the interest payments. You take the interest payments divided by the capital that's loaned, and you get an effective rate. Any effective anything, effective tax rates, anything that's considered an effective rate. That's basically you take the summation or the aggregate of what the capital that's loaned to commercial banks and the aggregate of all the interest that's paid and all of those transactions for that month, and that you get that rate certainly based on. And back there, it's not as simple as okay, well, the rate is this and that's it. It's a little more. There's a little more detail to it than that. Are 2 of these? No, there's not. Okay, so it says whenever the interest rates are rising or falling. Okay, we heard about that. Okay, and it says these changes can affect both inflation and recessions. Inflation refers to the rise in the price of goods and services over time. So you're getting a lot of definitions of terms here. It's the result of strong and healthy economies. If inflation is left unchecked, it can lead to significant loss of purchasing power. So the dollar buys less. To help keep price inflation manageable, the Fed watches inflation indicators such as the consumer price index and their own index, the producer price index, the price of inputs. When these indicators start to rise more than 2 or 3% a year, the Fed will raise the federal funds rate to keep the rises under control. The federal funds rate, we talked about this, influences the prime rate, which is the base rate from which other interest rates are determined, such as mortgage rates and rates on personal loans. Because higher interest rates mean higher borrowing costs, people eventually start to spend less. The demand for goods and services will then drop, which will cause inflation to fall. Okay, well, there you go. There's your, it says what's the effect of interest rates, inflations, and recessions right there. Okay, so again, you've got to gather your thoughts and make your comments like that. And like I said, just sending. I never would send. I send the guys I work with, this length of a narrative here, or this length of notes, but I'll put in a few lines. Say this is what's going on with this. This is what's going on with that. And again, you guys don't remember this because you weren't born. Your parents may not have even been born. But the inflation was at 14% in the 80s, and then the Federal Reserve increased interest rates to 19%. So that's actually that deserves its own line, something like that. This caused severe recession, but did put an end to the spiraling inflation the country was seeing. Okay, that's what's happening with that. And it's good to try to cut this stuff up a bit. There we go, like that. And similarly, we're trying to combat inflation this year, and we've been increasing rates, as you saw from the data set that we just looked at. Falling rates can cause a recession to end. When the Fed lowers the federal funds rate, borrowing money becomes cheaper and entices people to start spending. Okay, there's your recession impact. Okay, so like I said, so looking at this effects of interest rates on inflations and recessions. And again, you guys have to get that together. A good example of this occurred in 2002 when the federal funds rate was cut to 1.25%. This was post-dot-com burst. This greatly contributed to the economy's recovery in 2003 by raising and lowering the federal funds rate. The Fed can prevent runaway inflation and lessen the severity of recessions. Okay, this next piece, this is how. Actually, this probably deserves its own little page too. How much rates affect stock and bond markets? There's bonds right there. Then we have the effects of expectations. We're going to talk about that a little bit. Yeah, let's look next. What's the next thing here? And this is how do interest rates affect stock markets? How do interest rates affect the bond market? We're going to discuss that right now. When interest rates rise, it's more expensive for companies to raise capital. They'll have to pay higher interest rates for the bonds that they issue. Making it more costly to raise capital could put a damper on future growth prospects as well as near-term earnings. The result could be a revision downward in profit expectations going forward as rates increase. Now, I'm not going to name the company, but there's like a local landscaping company that's very politically tinged. I'll say it like that. Okay, and when I ride my bike, I see the name all over the place, and they do residential real estate, they do municipality real estate, they do commercial real estate, and they're very well capitalized. They're making money. And who knows, politically, I know some of the folks involved in the company, were very, you know, highly involved in Essex County politics. And you see on the truck they have the leaf blower, right? It blows the leaves. They have the lawn mowers, and they have a lot of this equipment. They have a lot of, it's not some guy with a truck and a hedge clipper and a chainsaw. It's, and you see these trucks all over the place. There's many trucks. Who knows if they have 10 trucks or 20 trucks or whatever it might be. They have big dump trucks. I'm just trying to think of the top of my head. They probably have a good dozen vehicles, if not more, maybe 20 or 20. Let's say they have 25 vehicles. Some of them are residential, some of them are commercial spaces, but they have probably have 100 lawn mowers, 100 cans of gas, and 100 leaf blowers, and edges, trimmers, the edge trimmers, and all this other equipment. So you have trucks and lawnmowers and snow blowers and rakes and shovels and brooms and all the stuff that you need. So if they weren't able to buy that stuff, now again, if they had the cash to buy $1 million worth of equipment, well, folks, let me tell you, 25 trucks. A truck is more expensive than a car. You have 25 of them and all the equipment that goes with it. You're talking to capitalize that. Say if you bought all the equipment and that, I'm just doing off time, it's probably in the $1 million area. $1 million worth of capital equipment, of lawn mowers and the machetes and whatever, all the stuff you use to do landscaping. Or in the neighborhood, maybe not $1 million, but it's certainly in the neighborhood of that. If it was one guy with a truck and he hired 3 people, he wouldn't be making the same kind of money that that a venture like that would be making. So one guy by himself, or one guy with his own truck or something, wouldn't be able to do it as much. So if interest rates are but if you had to borrow against your potential future business, and again, it's very difficult where if you're just starting out and you're not as well known, are people going to hire me? It's a tough case to make, especially if you're just starting out. But I think they were connected, and they had a gardening business, or where you go there and buy plants and buy trees for your backyard or whatever it might be. And that kind of stuff. So, they had a business where they probably built up a reservoir of cash and say, hey, let's expand into landscaping, and it probably started based on customer demand, saying, hey, so-and-so, can you help me plant this tree? Hey, so-and-so, you want to come, cut my grass? Hey, so-and-so, the snow is out there. Want to come? So they built it on the demand of the people in the area. So again, if you couldn't fund all that, you wouldn't have 25 trucks. You might have 1 truck, and you certainly not making the same cash flow as somebody with a dozen vehicles. So if a company's seen cutting back on its growth or is less profitable, it's either through higher debt expenses or through less revenue. The estimated amount of future cash flow will drop. All else being equal, this will lower the price of the company. So again, if you're putting a valuation on that landscaping business, or you're putting a valuation on whatever, on Coca-Cola, or a valuation on some bank somewhere in Europe or whatever it might be, the less business that they're going to have, the lower their cash flows. Certainly, the more they're going to have more of whatever cash that they do have just to service their own debt or pay off their own debts or pay taxes and things of that nature. And there's going to be less for I hate to say it, but the last person in line to sort of get satisfied is going to be the common shareholder. There'll be less cash flow for the owners, right? And that's less valuable. Obviously, you just do a time value of money computation. That a lower annual cash flow is going to result in a lower valuation for all those cash flows if that number's less in dollars, less in euros. So if enough companies experience declines in the stock price, the whole market or the key indices, many people will quit with the market. The Dow Jones, the S&P 500 will go down. With lowered expectations and growth in future cash flows of a company, investors will not get as much growth from the stock price appreciation. This can make stock ownership of the speculation less desirable. So furthermore, the investing in equities can be viewed as too risky when compared to other investments in a high interest rate environment. Because again, a lot of these companies do borrow a lot. And the more you borrow, the less capital you have, the less that list of Dow Jones companies or whatever it might be, the less of cash they're going to have to pay off their shareholders. Okay, if it's going to pay off the debt. Some sectors stand to benefit from rate. So it's interesting. a part of this somewhere in here, there's a comment that said, "Oh, well, it's everybody but the banks suffer," or something. That did we see something like that somewhere? Where do we see something like that? I saw something where there was a criticism towards or a negative towards the banking sector. Where is that? Um, yeah, right here. It says have a negative effect. Often with the exception to the financial sector. Fine. Okay, so and here we're saying, one second, the benefit. Okay, benefits is the financial industry, banks. Okay, sure, and insurance. But here's the thing, though: if your customers aren't paying, so again, you've got to temper the force of okay, we have higher interest rates, and if you're dealing with a customer base where they're all quality customers that are going to pay them, they're going to pay their cash flows no matter what, then that's good for you. But if these are people who are going to be delinquent on the payments, and that could be a big problem, and that could be a problem in America, that could be a problem in other parts of the world. Okay, so it's no guarantee. Okay, just because we have higher interest rates now and we're getting sticker wise, theoretically we should be getting more payments. But if the companies can't pay because of reduced economic activity, then what? Okay, so it's not such a given. So, well, the financial industry will be okay with higher interest rates. That's not such a given all the time. Okay, so you have to balance all the different forces that are at work here. Banks, brokerages, mortgage companies, insurance companies, earnings often increase as interest rates move higher because they can charge more for lending. But again, if your customers can't pay, that's that can be a problem. That's for stocks. Now with the bond situation, and again, you have to think about it. You're going to lend somebody $1,000 for 2 years. You're going to get $1,000 back in 2 years. They're going to pay you $50 interest the first year, $50 interest. That's like a 10% interest rate or whatever it might be, or 10%, 5% coupon bond or whatever it might be. So $50 the first year, $50 the second year. So 5%. That's a 5% bond. And but and you could do the math on the time value of money of getting $1,000 in 2 years and getting $250 payments or whatever it might be, or four $25 payments, or however it is you want to look at it. But uh, if the market, if the environment is out there where there's a demand for that bond. Okay, so in other words, if there's a higher interest rate out there, someone's going to go for it. So the money might come out of that particular bond and go into another particular instrument. So if the money's coming out of the 5% bond and going into a 6% bond, the 5% bond price will be lower and there'll be a bigger yield for someone who buys that instrument, even if they forego a 6%. Again, you're balancing. Okay, if I may pay more for the 6% bond, but what's my yield going to look like if I got to pay a higher price, even though the interest rate is higher? What's my yield going to look like if I have to pay a higher price for that particular instrument? That's how. Now again, there's an example here that says the reason for this is actually quite straightforward. It says as bond prices fall, as interest, and says, well, I'm sorry, it says interest rates, meaning that as interest rates rise, bond prices fall, and as interest rates fall, bond prices rise. Actually, those should be on separate lines. So let's do it like that. Relationship between meaning interest rates. Let's do it like that. Okay. As interest rates increase, bond prices fall. Well, the current, again, are you talking about current bonds, future bonds? So if people are in bonds now and they're jumping out of a 5% bond to be in a 6% bond, when has that price been bid up where that transaction is no longer make a lot of sense because you're paying so much to be in the other instrument, kind of a situation. So that's, again, you've got to balance all the different forces that are sort of at work here. And we'll do it like that. Yeah, like that's good. So as interest rates rise, bond prices fall. Okay, and then meaning as interest rates fall, bond prices rise. Well, again, looking at sort of that particular inverse relationship. Yeah, I mean, if capital comes out of a debt instrument and it piles into equities, because the whole idea behind a lower interest rate is to encourage the return seekers to be in the equity market. So those instruments get bid up, kind of a situation. And here it says, well, bond prices, it says interest rates fall, bond prices rise. Well, are they talking about bond price? They're talking about the value of that bond. So if the interest rates are falling out there, you're not going to have a gigantic demand for a low interest rate or no interest rate, very very low interest rate treasury instrument or very low interest rate debt instrument. You're not going to have tremendous demand, so that price is not necessarily going to get bid up. But theoretically, for people who are holding, and if let's say there's a variable interest rate or something to that effect, and that interest rate declines, based on the financial, based on the economic conditions that are perceived by the Monetary Policy Board. You're going to be looking at a bond price. You're looking at a price appreciation for this thing, in the sense that you're changing, you're lowering the distance from what you pay versus what you're going to get from. When you lower that distance, you're going to increase, I'm saying your return is going to be higher as capital piles in to a more assured debt instrument. You're going to shrink that yield. So that's, you have a decline when the capital piles in. That's what I mean by bond prices rise. So if you've got instruments where it's bid up in the market, the yield declines. That's what it means by interest rates fall, because people have a demand for that. Okay, so yeah, so like I said, you see this in the Wall Street Journal a lot. So I've spoken about this in past videos. But like I said, you really got to sit there and you really got to think about are you talking about yield? Are you talking about the coupon rates? And again, let's just sort of starting from line one again with the bond situation. So yeah, so as capital outflows from an instrument, all right, the market price gets lower. As the market price gets lower, it says as interest rates rise, it says the yield will increase. So if you've got current bonds that are out there, as interest rates change out there, your return on the current bondholders' yield is, if capital comes out of the current bonds and goes into a bond where there's a bigger interest rate, you're going to have a bigger yield on that particular bond, and you're going to have capital leaving the lower yielding bonds. And as capital yields, your yield on that particular bond increases, or your yield on the new bond is going to get bigger, because there's a bigger coupon rate, because to raise capital, companies have to do that. So in either one of those situations, as the interest rate rise either from current bonds or going into a new bond, the price is going to be actually you're leaving, capital leaves the current bonds, the lower coupon bonds, and then you're increasing the yield on that particular bond by the capital leaving it, and people can buy those payments at a lower price, or you're going into a higher price or higher coupon yielding instrument, and that's going to give you a more a bigger yield as interest rates are increasing policy wise. The reverse, as bond prices, as capital piles into bonds, you're shrinking the yield, is what you're doing. So as interest rates fall and people pile into these things, you're looking at less of a yield. Also, in terms of, as it says, when interest rates fall, and says bond prices rise. Well, yeah, that's looking at, again, that particular situation in terms of how the interest rate behaves with these particular debt instruments. Looking at that, so well, the interest rate is declined. Well, if the policy wise, you have a decline in interest rates, and again, if capital chases, those lower, if capital chases those lower rates. 1 second, folks. Stay in the call. Yeah, if capital chases it, you're, in terms of the prices, you're going to be shrinking that yield, and that's basically what they're trying to say. And let's see some of their other examples. It says the reason for this is actually quite straightforward. Say a bond with $1,000 face value pays 5% interest. Okay, I think we're talking about this at a fixed rate. It is issued when prevailing interest rates are also 5%. A year later, interest rate rises to 10%, so the investors can now buy a new bond for $1,000 and be paid $100 a year for holding it. So this means the old bond, which pays only 50, has to be worth less. So the only way somebody would buy the 5% bond would be to discount to the market. Right. Correct. So looking at that, so again, interest rates rose, but for someone to go into the older bond, right, you're going to be paying less for that because the yield isn't as great. So now let's say now the other version of this is if interest rates fall to 1%, a new bond purchase will only pay $10 per year to the bondholder. So the old one, the pace is now very attractive, and the market will bid that up. So it trades at a premium to the market. Okay, so again, as interest rates decline, but you're still holding that reference bond, capital is going to pile into that reference bond because it's got a higher coupon compared to what's out in the market. Like I said, you got to understand: is it a new bond? Is it a bond that you're holding? So all of that plays a role in this. Okay, so that's so this whole premium to the market, discount to the market, it's really that you have to have this make sense. I gave you a little bit of an explanation of this, but you have to have this make sense to yourselves. What's really going on with this. Okay. Now, the sensitivity of a bond's price to interest rates is known as the duration. The longer maturity of the bond means it will fluctuate more in relation to interest because it's exposed more. It's exposed to the market gyrations out there. So, and again, so as interest rates move around now for the 10 years from Obama's year to the beginning of Trump's term, Trump's first term and Obama's through Obama's two terms, you had a very a relatively stable federal funds rate. You didn't have a lot of fluctuations in terms relative interest rates. But now you from a couple of years ago to now, I think we saw from the data, you moved up a good 2%, and that's a lot. Compared to the last 10 years, that's a lot of movements in interest rates. Yeah, we have something about expectations here. So, and it says one way that the governments and businesses raise money is through the sale of bonds. Interest rate moves up, the cost of borrowing becomes more expensive. This means the demand for yielding bonds will drop, causing the price to drop. So as interest rates fall, it becomes easier to borrow money, and many companies will issue new bonds to finance expansion. This will cause demand for higher yielding bonds to increase and forcing bond prices higher. Issuers of callable bonds may choose to refinance by calling their existing bonds so they can lock in a lower interest rate. So from an income or for income-oriented investors, the reduction in the federal funds rate means a decreased opportunity to make money from interest. Newly issued treasuries and annuities won't pay as much. A decrease in the interest rates will prompt investors to move money from the bond market to the equity market. So the influx of new capital instead can cause the equity markets to expand. So yeah, so there's how it's. So we have a decrease in interest rates. What's going to happen to the equity market? What's going to happen to the bond market? And what the thing. Like I said, you have to make sort of one statement about everything. You have to look at the specific scenarios that you're looking at, and then try to make a statements about that. Okay, but this is I think the best part of what's sort of here. And you got to keep that in mind. Okay. And like I said, okay, fine. There are policies that are out there. Bond prices generally falling means capital's leaving, the current instruments and are going to go into something else. So as interest rates rise, it's leaving the current bonds and going into something else. Another debt instrument with a higher coupon payment. That's really what that means. So as the policymakers change interest rates and capital flows out of those instruments, and also what happens, the reason that the yield increases as the interest rate increases in those old instruments, as capital leaves that, you're still getting that 5%, whatever it might be, but you might be able to buy that for a lower price, so you're getting a higher yield. So as policymakers increase interest rate, on an existing bond, there could be an increase in yield because of a lower price, because it says bond prices are falling, so capital is flowing out of those older bonds. And then similarly, as interest rates fall, and again, you're holding, as you're holding a current, you're holding a 5% coupon rate when interest rates, as they had an extreme example, so interest rates are going to be 1% or whatever. But as interest rates decline, and you're holding a 5% bond, the market demand for that is going to be higher because other instruments aren't as appealing, but your 5% one is going to be appealing. So capital is going to chase that. And there's other examples, but that's the example that I use. But you could use other examples for that too. Okay, expectations. We have expectations, and then we have a couple questions. Then we have the bottom line, and then we'll hit the. We're going to hit the. Actually, you know what we'll do? I saw how long this is all. We're sort of here. So here, sort of in the middle of this right now. Let's, if you guys don't mind, I'm going to put, because we could pick this up, because this is actually the whole interest rate thing is pretty important. So let me do this. I'm going to read this out like that. We can come to expectations. So here, so in terms of your assignment, I think we've hit, impact on the stock market, impact on the bond market. We've hit that. Okay, we've hit all that stuff. Like I said, and you get your own interpretation out of all this as you sort of go along here. I can pick that up tomorrow. So I'm just going to make a note for myself here. Tomorrow is going to be, because this was long, expectations, and then the questions on federal funds rate, interest rates, and markets. That'll be tomorrow's graph. Okay. All right. So I want to hit this other. This is going to be another half hour doing this. So, okay, we're here. So again, you also, and this, we're not finished with this, but if you see this, so we're only going to work on this. See what it says, St. Louis Federal Reserve Bank and the graph and all that stuff. Let's hit that. Okay, I gave you the link here, and here's what you could do. You could just copy the link. I just copied the link right there. And there it is. There's your data. And of course, going back to the 50s, 1, 2, 3, 4, 5, 6, 7, 8. So you have the 10 recessions going back to the 50s. And again, I'll let you know when I figure out how to make those vertical columns. Now, I can have you graph the whole thing, but I wanted to match this up with the S&P 500. So I think when we went back to like the mid 80s, like to here or something, but you can see it generally fell off a cliff. Okay, this generally now I graphed it somewhere. Okay, but it generally fell off a cliff. And actually, um, regulation assignment. Oh yeah, I did graph it right here. Yeah, so you're going to do this. You're going to make that. Okay, and the data's here. This is the S&P 500 data that came from Yahoo Finance, and this only see I was limited by this. This only at least the version of this that I had my hand around. This only could went back to like the mid 80s, like the mid 1980s. But look at this. What are we at? We're at the recent close was about 3,000 and it's gone down since then. 3,000, and here was 100 in 1985. It was 179. This index was 179, if you can believe it. Okay, so it's it was quite a while ago. It was and actually we'll go through making the graphs of this stuff and flipping everything. And there's a lot of stuff to do with Excel. There's a lot of I did a flip. I flipped the data. I'll explain to you how to do that. See, so when I make a graph of this, I don't want to start with September 22. I want to start with January 1985. And you have to flip it, and I'll show you how to do the flipping and all that. But like I said, for now, we're just going to concentrate on this. Okay, let's just concentrate on the federal funds rate and the detail here. That's all I really want to concentrate on for today. Okay, so we're there with this. This was, and actually, I gave you the data. Yeah, this is the student. So you could just show up here like this, and you could just take this and say Control C for copy, and then you can go into your and actually your Excel should have the following. Let's make this big. So I'll go to sheet 2. We'll right click. We'll say rename. This is assignment 3. So I see how I named, and you could just parachute it in here and just pass it off right there. Okay, that's one way to do it because I provided the data to you, and you can make this bigger. Okay, and actually, I'm looking at this. It says federal funds and all that. Did I? Because I want to show you how to download the data. I want to show you how the data gets downloaded too. So actually, let's do that now. So here, go to the St. Louis Fed. See what it says download. Now look, this is 54, but you want to do this in the 80s, like 85 January. See what I'm doing? And the 1st, yeah. Okay. So you limited the data to whatever, and it's monthly. And you see what it says edit graph. You could make the data monthly, quarterly, semi-annually, percentages, the units, all that stuff. Okay, so that you just hit the edit button, just hit the edit graph button. If you hit download and you want to do it to Excel data, because you have a couple of choices there. And again, you should be used to downloading data. Okay, you should be used to downloading data. Open your download file. And you're right. And actually, looking at this, I don't know what happened here. We'll do enable editing, whatever. Yeah. I wanted that block of detail up there. I don't have it for some reason. I don't know why. Hit escape. Tab over. Funds. This cut paste like that. Okay, I wanted this stuff. I wanted. I don't know why it's not there. There, right there. And this is we don't need that. Yeah, I wanted to have this sitting there like that. Does mine have it? Man, mine does it or doesn't have it? Yeah, I don't think mine. I don't think my yeah. This is the master copy. I don't even think we have it here. Oh, undo. There it is. Okay, yeah, you should have a nice heading on your date. I don't know why I didn't. But you guys can do that. You can put that up there. Okay. No, we know. Okay, federal funds rate, fine. It's monthly, but you want to understand its percentages, effective rate. Okay. A little better, a little more. See this? It says S&P 500 real time price, currency dollars, even though it's an index, but currency dollars, that stuff. You want that all. You want the detail, right? You always want you want to know units, and you want all that stuff when you're dealing with this stuff. Okay. So yeah, so we down here's the data here, and you sort of saw what I did, but what we'll do in the video version of this, we're gonna highlight the data, the time series and the rate, and then we're gonna go into our version of this here, and I'm just gonna drop this sort of right next to it. There. Okay. I'm just gonna drop it there. Open this up a little bit. Now, this is already formatted and everything, right? We have that already all formatted. Okay. And also, I want to look at escape. Yeah, you want to number your data, and we're going to go into numbering data. So we're going to go into all that. All you basically do, you downloaded your data from the Federal Reserve. That's all you did right now. And you need all this other stuff. I'll show you how we sort of get to this. So what you can do, you just go right to the federal funds, take all these headings, copy. You can, yeah, I just did it. You can drop it here. You can drop it here, drop it into a notepad. Gets rid of the formatting and all that stuff. Frequency monthly. Hit it anytime you highlight something. You want to hit escape. Okay. And and we'll get to messing with this. But so here, so you're just going to take this, you're going to cut it, and you're going to put it into your video file. We'll do right up there. That do it? Did I just get it? Yeah, I actually just got it. Okay. Always give yourself some space too. This is a little too much, too on top of each other for me. We're gonna cut here. This is going to be the date, and this is going to be observation. Center that, bold it. I'm going to open it up a little bit, all right, so you can see that a little bit better. And this is rate. And these you can format that stuff as text, center, and the font being black and bold. You want to make that bold right there. Okay, so you want to so this is your time, this is your x-axis, this is your y-axis, and you can see here we have everything labeled appropriately and all that stuff. Is this right? Yeah, and even with this, so up that a bit. Okay, so you have all that. This is italics. This is bold. Okay. Now, if you look at this, this obviously looks a little bit better than this. So let's say shift control down. Let's say control 1. You want to center this, and you want it date, and you want the slashes, the slashes version. You want to center it. You want the date font could be a little bit smaller, and it could be in italics. And then you can hit OK. See? And this is whatever Calibri, but you could just go to Times New or something like that. There. Or whatever. However, you could bold these or not, whatever, however it is you want to do that. Okay. Arial. I used to use Arial long ago. I used to use Arial a lot. Do we have Arial somewhere? Yeah, Arial's pretty good. I like Arial. So with this, we're going to go to Arial, and it's a number, so we'll go blue. I want numerical formatting. Yeah, 2 decimal places. I want to center it. See all the stuff I'm doing? And you hit OK. And that's got to be bolded. Or it doesn't have to be bold. Nah, we don't need bold on that. Good enough. Okay. And what you can do, even though this is sort of jammed up here a little bit, and see with the graphs, we're just working in Excel. So we don't have to worry about, do we have this in the right place or something? We don't have to really worry about that. Yeah, because I'm saying if you were directly working in Excel, sometimes I'll do that. I'll just do everything in Excel, kind of a thing. Like some of the folks from last semester, I probably remember I worked like that. It depends how we sort of do things. But there you go. So now you have your percentages. Right? It's percent monthly. Okay, and actually my version should have the same detail here. Percent monthly effective rate. Okay, good. Okay. Sorry about that. So there you go. So yeah, so you have the federal funds rate, and you can see obviously in the 80s it was still pretty high. Like I said, and we'll graph instead of clicking through all the actually. And you also want to count your data. So type in a 1, make it italics, make the font a little bit smaller, center it, control 1, number. I don't want any decimal places. I don't want commas. I don't need commas. You can leave a black font. Hit OK. Bring the formatting with you, equals 1 plus. So just add 1 to all of these indices. And what you're going to see, I think it's like 400 or something. Yeah, about 450 pieces of data. And like I said, you want stuff like that. You want the data you want your data set to be the thing that catches the eye. So the font is a little bit bigger. This is 10, this is 10, this is 11. See the font up there? It's 11. So okay. And now we're going to say shift control down arrow. You're going to say insert. You'll go to scatter. You could go with the straight scatter with straight lines, and you're on your way to doing this. See what it says layouts? You can pick the one with the chart title and the axis title. You could put those in individually, but it just does it. This is a little convenience button. You just do it once. It gives you all 3 elements at once. You want to go to select the data. You want to go to edit. You want to go to click on X value, and you want to click on the X, the time X, and you want this. See how the dates match the interest rates? You want that to be the same. Okay, and this can just be percentage monthly, something like that, and then hit OK. And then also, obviously, you don't want the legend taking up half your window like that. So you can click on the graph in the corner, go to layout, and go to legend top. See, all of a sudden, it straightens it out a bit for you. Okay. Now we have a lot of work to do on this. So here, this is the data. We don't need that anymore. And like I said, I gave you the data. The data is here. So I mean, you can just copy and paste the data from mine, but you have to have, you have to have the hand dexterity to do all this. Okay, that's really what we're trying to teach you here. It's like pitching, it's like hitting, right? You got to have the hand skill to do it. Okay, we open this thing up now. Obviously, this looks like the correct shape, but this goes back to whatever, to like 1900. So what you'll do is you want to right click on these numbers and go to format the axis. See what it says maximum minimum? This is whatever, 50,000 or something. You want to click on fixed, and I don't know. You want to do maybe 30,000. And major unit, maybe 300, something like that. Yeah, see how so the 30,000 gave you, I don't know, I don't want to say, I think it's by the days. So if you do whatever, you do 50 years times 300 or something like that, you can sort of get, you have to have a feeling for it, but it's got to look like this. Okay. So like I said, so when you right click on format the axis, now you're 30,300. Here, you can right click here, go to format the axis again, go to alignment, and you could type in negative 75%. See how all of a sudden it gave them all these dates and angle? And also, they don't need to be very big. So you can make it a 9 font instead of a 10. And also, it's a little cluttered for me. So go to format axis again and do maybe 350. They gave it a little, I felt a little more movement on that. Control A, click on the title, Control A, rate. You could put a border around this, do the outside border. That's monthly rate. You don't want to skip a percentage. Right click on the numbers and go to format the axis, and you want to go to 1% instead of 2%. Okay. Click Control A. This is percentage. Since it's highlighted, you can just go to the outline and just outline that. See, very, very quickly, it looks pretty good. And see, when you click on the line, both of the columns, the time column, I'm just going to cut that. The time column and the rate column both light up. See this when you click on the blue line here? See, both of them light up. You want that. Okay. What else? We're going to outline the graph. Right click. You want like a heavy outline for the graph. You want to fill it with a very light color, or do a fill. Right click, format the plot area. You want to go to shadow, put a little shadow in there. And see these grid lines? You could right click on the grid line, do format grid line, style, thin it. You want to put some dashes, and with the color, let's be adventurous. Let's do a purple. I like purple, or blue. We can do blue. Okay. And we're still not done. So now we have to click up here. This is federal funds effective rate percentage. And again, do an outline and then save. There you go. That should have been, folks. Again, I did so many of these as Valorant graphs. Always did every day. Your assignment, I did that every day, something like, or almost every day, but at least 4 days a week. And and certainly the analysts in Morgan Stanley and all that, they're chasing everything around all over the place. Corporate finance, I guess it depends on the firm and how they define corporate finance. But corporate finance, either it's an internally looking sort of like a congressional budget office type of analysis group, or it could be analyzing the deals like the acquisition team. So it depends on how people define their corporate finance function. Okay, but there you go. And now, like I said, with this, and I've done this before. So here, let's go back to notes or something. Here, I'm just going to make some space at the end of this. So all I want you guys to do is click on the graph, say copy, and click on your Word file and just paste it in there. Just like that. I don't want everything else, the table, unless I ask for the tables. I don't want the whole other, everything. I don't want that. I just want this, like this. That's all I want. Okay. And then you type the answers to your questions in here, and then you hit the PDF button. See PDF, and it creates a PDF like I did at the beginning of the video, right? That's all you're doing here. You're creating the PDF, and that's it. That's it. So you're not worrying about, do we have it? It's selected and all these other things. You don't have to worry about that. Okay. But that's the federal funds rate. And like I said, so what we're gonna do, and like I said, I'm gonna leave this here, for the time being. But you it doesn't, you don't really need that. Um, Tomorrow's video, we're gonna pick it up with the effective expectations, and we're gonna talk about the Standard and Poor's a bit also. Actually, this thing, I'm gonna take this. I'm gonna click it here. You're gonna see see how I'm selecting the whole row. I'm just trying to give myself a little bit of room in here. Right there. See? So that I'm inserting 20 lines or whatever it is. So I can pick up the graph, say cut and page up and go right there and say paste. And that's it. Okay. And actually what you can do here, since we didn't need all this dead space, delete, delete, delete. Okay. It's better like that. So you see the graph first. And we'll put the Standard and Poor's one in there. Okay, but certainly as you're looking at this, a very high federal funds rate, boom, recession, right? What was this? This was the 91 situation, right? Because there was a recession here. The dot-com burst, boom, recession, high federal funds rate. Great recession, boom, right? High federal funds rate, recession. COVID falling off a cliff again. Okay, so the four times in the last whatever years, in the last 30 years, the four recessions that we've had, you can see what the behavior of the federal funds rate was. Now, certainly, as the economy behaves, it causes the policymakers as a policy for monetary policy. That's what that's what these people work on. That's why it works and how it works, kind of a situation. Okay, so this is set to cool off the economy, and like I said, this was a good enough set of notes. So we pretty much hit everything for the assignment, but we're going to come back. We're going to hit effective expectations, and also I'm looking here. I don't recall if I gave this to you guys or not. Yeah, I did, because you have the data here. So yeah, so you guys have these notes. We'll talk a little bit about what the SP 500 is, and there's some examples here. I'm not necessarily going to go through these examples, but these are nice to look at. How the different indices change and things of that nature. But we're just going to talk about the tech stuff. I've taught this in statistics, and actually this one's not even highlighted. But that doesn't mean we can't talk about it. So, but here it says the company weighting is the total company market cap divided by the total market capitalization of all the 500 stocks in there. It's unwieldy. I mean, the Dow Jones, you could do some computation. There's only 30 companies, but it's unwieldy when it's 500. That's when you need a team of people, and you're recomputing all sorts of things. So yeah, so you guys have the data here. You have so you could just work. I wanted to show you from the St. Louis Federal Reserve website, but you guys have the data here, and you can just work from here, and this is fine. Okay, you guys are okay with this. Actually, what I'll do is I'm going to repost this with the student with the heading in there. I gave it to you without the heading. And like I said, we'll pick this up next time. And like I said, and looking at the assignment, so we hit enough pieces of this. So we'll hit number 9 tomorrow, and we'll continue our great conversation of interest rates and markets, and we'll discuss. And like I said, you want to keep it straight in your head. Are you talking about a current debt instrument? Are you talking about a new debt instrument? Are you talking about what yield are you talking about? And interest rate policies and all these other kinds of things. So you want to sort through as much of that as you can. So you want to just keep that in mind. Okay, folks. All right, folks. Very good. Thank you for paying. I know this was long today. Thank you for paying attention, and we'll see you soon.